Hi, my name is Elliott Gue and I'm the editor of the Energy Strategist. Today I want to talk about both the crude oil inventories report, which was released yesterday, as well as the natural gas inventory report released today. Basically yesterday we actually saw crude oil prices strengthen notably. They actually had tumbled earlier in the week to actually under $100 a barrel at one point. And we saw them strengthen yesterday. Really the part of the oil inventory report that was bullish was the gasoline aspect of the report. Gasoline inventories dropped about twice what had been expected. Crude oil inventories actually rose more than expected, which is generally bearish. But gasoline inventories was the big number, down more than 7 million barrels, and of course that was about double what had been expected by most analysts. However, if you look at the charts of the inventory figures, which I am posting on the blog today, what you'll see is that gasoline inventories are still way above average for this time of year. The reason that they're dropping so aggressively is really that the refiners have cut back on their output. They're running at in the low 80% of capacity, really not boosting production much in a time of year when they normally do ahead of the summer driving season. So that's what's really driving that drawdown in gasoline inventories. Crude oil inventories, of course, as I said, are built this last week and are sort of in the upper half of the average range for this time of year, so nothing particularly bullish there either. As I've been saying for some time, fundamentally the inventory picture in the United States isn't particularly supportive of higher oil prices. However, the weak dollar certainly is, and that's really what's been driving oil, I think, for the last several weeks. Another fairly bullish aspect of the report is that demand for gasoline appears not to really be shrinking a whole lot, even though we are seeing high prices. A couple of weeks ago, you'll remember one of the reports came out and showed a fairly large drop-off in demand, and that really catalyzed a pretty severe sell-off in oil prices from their highs. And this week's report really didn't see that. In fact, if anything, there's some evidence of an increase in gasoline demand, despite the fact that prices are so high, just hit a record at the retail level, and of course the economy is weakening. Overall, this is fairly bullish report for the refiners. What we had seen is that refiners make money on the spread between gasoline prices and crude oil prices. So the price of crude oil going up really hurts the refiners because it means their feedstock cost is higher. What's been happening this year is crude oil prices have been going up faster than gasoline prices. The offshoot of that, of course, is that refining margins, what's known as the crack spread, has been declining. With yesterday's report, we did see gasoline prices spike up a little bit. Crude has actually remained relatively subdued, actually pulled back a little bit today. So those crack spreads are actually widening. Typically that happens this time of year. Longer term, I have some concerns about the refiners with a lot of new refining capacity coming online. But from a trading perspective, I think the next 3 or 4 weeks is probably a pretty good time to be in the refiners. I'd look to sell them out sometime in May. The more important point I want to bring up is natural gas. Again, natural gas prices pulled back today. Inventory drawdown was a little bit less than a lot of people have been expecting, but the picture remains broadly the same. Gas inventories are a little bit above average, but they're about as close to average as they've been in about two years plus. So gas prices, I think, are fundamentally well supported. We're still trading on the strip, the 12-month strip, around 10. We've been as high as 10.50, and it's been sort of trading in the 9.50 to 10.50 range for quite some time. So I think that they're well supported in that area. In fact, if you look at the stocks levered to gas, companies that I've mentioned several times here, including, for example, Neighbors, which is a land driller, those companies are actually doing quite well, as are the exploration production companies that are gas-focused, even today when gas prices are down. And that suggests to me that those stocks still aren't pricing in the full brunt of the recovery in the natural gas market that we're seeing, and I think we'll continue to see. So I think that's a very interesting area to be in on a 6 to 12 month type of horizon, and I actually think that you've got some good entry points there now. Neighbors is starting to really run, and I think it's probably a very good time to get into it before it really starts to ramp up. The other point I want to bring up about natural gas and oil is there was a prominent article in Barron's over last weekend, most of you probably saw it, where they actually talked about the bubble in commodity prices. And the main argument there was that the data release, the Commitment of Traders report, released by the CFTC every week shows huge speculative positions in the crude oil market. To be honest with you, I really don't see those being that excessive. If you look at the actual data, the net long position in crude oil futures has been rising quite notably. There are a lot of speculators in this market, but it's really not, considering how much crude oil has run up, it's really not that surprising that you're seeing a lot of these trend-following type funds get into that market. But one thing I do take exception with on that article, I do believe that probably, as I've said several times on this webcast, that oil prices could pull back into the 80s or even lower short term, although I think beyond that you look at the fundamentals really bailing it out. And part of that could be the speculators in the oil market. But one part of that article that I really take exception to is the way they sort of treat all commodities as sort of one group or one commodity. And they talk about excess speculation in commodities generally, when in reality it's more of a localized issue. In other words, net long positions in crude oil are a little bit high and have risen a lot over the last several weeks. However, let's look over the natural gas side. The same report there shows a huge short position that is being held by hedge funds and other types of funds in natural gas. So the same speculative unwinding that could hurt the oil market, if those speculators chose to unwind their shorts in the natural gas market, natural gas prices actually might spike. So when you look at commodity markets, I don't think you can really generalize and say, well, copper and gas and oil are all the same. And the idea that there's speculative excess in the natural gas market is completely ludicrous. If you look at the actual data, hedge funds really have never been this short natural gas. A very, very large short position there. So the idea that natural gas prices are going to come down because of an unwinding of speculation just doesn't hold water in my view. So just to summarize, I think you might have a trade in the refiners here over the next several weeks with the widening of the crack spreads. But my long-term favorite remains natural gas and stocks leveraged to the natural gas recovery. Thank you very much.